From 11FS, this is Fintech Insider News, and I'm your host, David Brear, the CEO here at 11FS. Thanks for downloading this podcast. If you like what you hear, why not recommend it to a friend? This week, we're talking about HSBC pulling out of the new markets in a bid to really double down on Asia. I mean, this is a really interesting one. It's a trend that we've seen from HSBC and a few other organizations as well to retrench in order to bring about a new level of focus. We were also talking about Chip reaching its first monthly profit after an insane 9 months growth spurt. We had the guys on from Chip to talk a little bit about the customer numbers, what the strategy is around that, and actually what that means for them as an organization as well. And lastly, and a bit of a weird one, I'm not going to lie, a self-service tills coming to an end. One British supermarket chain certainly seemed to think so. And we got into really what does the premium experience mean in a physical and a digital world. We'll get onto this and so much more in today's show, but back after these messages.
Hello, it's Benjamin here, Director of Research and Strategy at 11FS. Earlier this year, we published Building the Future of Home Buying, a report that calls out financial services for making the biggest, most significant purchase of most people's lives way more difficult than it needs to be. Well, fast forward to today and things haven't changed. Mortgage offerings are more important now than they have ever been, with sky-high interest rates in many countries forcing home buyers to shop around. We've got clients asking us how to move quickly to fix the problem and get a game-changing product to market. Want to know the secret? Step 1, download the report at 11fs.com/homebuying. Step 2, get in touch at 11fs.com/ventures. Speak soon. Hello and welcome,
LFG people,
to Fintech Insider,
Blockchain Insider,
11FS Spotlight,
11FS Explores,
Open Mic Night,
After Dark. Through our podcasts, videos, newsletters, and live events, we have a direct line to a truly global fintech community. So if you're looking to sponsor and collaborate on content that connects with everybody from fintech beginners to the biggest VCs, then chat to our team at sponsors@11fs.com or visit 11fs.com to find out more.
Long live the community.
Hello and welcome to episode 804. 804 of these, wow, of Fintech Insider. I'm David Brear, the CEO here at 11FS. I'm joined this week on Fintech Insider News by some super duper awesome guests who are here to break down this week's breaking stories in fintech and financial services. Firstly, a big hello to my co-host, Rachel Pandyan, who is a ventures product lead here at 11FS. How's it going, Rachel?
It's going well. Very excited to be back here again.
How are you feeling? Because, I mean, it's second time on the show, so are you feeling a little bit more comfortable this time? Or is it like still sort of, oh my God, like we've got to do all the things?
I'll be honest, I still haven't listened back to my last one. So I don't know, maybe after a few more of these, I'll have the confidence to listen back to all of the things I've said and maybe regret it.
It's for the best. I don't listen back. But we were both out last night. Obviously, it was the 11FS 2023 awards. How are you feeling after quite a late night? And I mean, lots of good whooping and shouting for people winning awards, right?
Yeah, I'm pretty impressed with myself. I brought myself home at a very reasonable time, so I'm feeling fresh as a daisy. But it was so amazing to see everyone come together and hear some of the stories of the award winners and the nominees as well. It was honestly such a great event.
It was pretty cool. I apologize in advance to everybody listening to this. My voice is going to do weirder things as we go on just because of how much talking I did last night. But let's see how we get on, hey? All right. I'm also delighted to welcome back to the show Alex Johnson, who is the founder of Fintech Takes. Great to have you back on the show, Alex. How's it going?
It's going well. Thanks for having me back.
No worries at all. For the listeners, give a bit of a pitch for you and what you do.
Absolutely, yeah. As you mentioned, I founded and write a newsletter called Fintech Takes, and it just looks at the intersection of finance and technology, and just is an excuse for me to follow my curiosity wherever it may lead in fintech. So that is what I do on a day-to-day basis, and then some podcasting as well.
Ain't it cool? We get paid to like geek out in stuff that you're really passionate about doing. Like, take that, career guidance counselor in high school. You know, like it's a lovely thing to do, isn't it?
That's right. Yeah, they thought I'd never amount to much, but I get to write a newsletter every week, so it's all working out great.
Yeah, I mean, I feel like at this stage there's going to be like some long shout out to like that teacher that didn't believe. Let's move on at this stage.
Fair.
All right. Finally, a Fintech Insider debut for Paul Delaney, who is the head of commercial over at Chip. Delighted to have you here, Paul. Give us a little bit of background on yourself and your role. You guys have got some exciting news as well in the show a little bit later, but we'll get into that later. So tell us a little bit more about your role at Chip and what Chip does.
Thanks very much, David. And can I just say as well, I'm very, very pleased to be here. I'm an avid listener of the podcast. So it's a lovely, lovely day for myself. And I'm really pleased to be here. So Chip is the wealth app. We are a savings and investments platform in the UK. And we've recently announced some very exciting news, which we'll touch on later. As you said, I'm the head of commercial at Chip. I'm responsible for all of our third-party strategic partnerships and relationships. And I also work very closely with our product and strategy teams on delivering new products and new bets. So that's what I do.
Very, very cool. And we'll get into your news a little bit later on in the show, but some biggies in there as well. So great to have you on. Right, we better get on with the news then, I guess. First up, we had a story that was covered in a bunch of different places, but we picked it up from MoneyWeb, which was HSBC to sell retail and wealth business in Mauritius as it refocuses on Asia. Europe's biggest lender is selling its wealth offering, retail and business banking in Mauritius to ABSA Group, impacting approximately 38,000 customers in that area. The sale is the latest in a string of exits from HSBC following the 2022 sale of its Canadian businesses to RBC for £13 billion and pulling out of the US retail banking market in 2021 as well. The bank could exit as many as 1 in 5 of its current markets as it sets sights on expanding its business in Asia. The Mauritius deal is still awaiting regulatory approval, but it is expected to complete in late 2024. ABSA Group are already operating in Mauritius and see the purchase of HSBC's customer base and the branch network that goes with that as well as an opportunity to increase its footprint in the region. I mean, this is an interesting one, isn't it? I mean, we talk about, fintechs focusing on doing something brilliantly and, then moving on after that. But I mean, it's an interesting strategy, isn't it? I mean, Rachel, maybe coming to you first. It's an interesting strategy for big organizations to retranche a little bit, be focused and then go again. It's not the only bank that we've seen this. Obviously, NatWest did a lot of this not so long ago in terms of pulling out of the international markets to sort of triple down. And it's kind of worked pretty well, pretty effectively for them.
Yeah, and also we've seen that with Barclays too. I think with HSBC, it's such an interesting one, mostly because of their presence in Asia. And I also think the Asian market in general, we've seen this huge immersion of digital initiatives that are unlocking financial inclusion for not just a small amount of customers. We're talking about millions of customers who haven't been banked before, who now are entering the scene and are a customer group that HSBC could quite reasonably target. On the flip side, we think about Mauritius, a really sophisticated marketplace, but ultimately quite small when you think of the piece of the pie that's on offer. And so to me, I think it's less about moving away from Mauritius, but more doubling down on a bet that in the long term has more returns for someone like HSBC, who seemed like a more prominent player in the Asia space.
Yeah, it's an interesting one as well. I kind of think from you look at kind of big global organizations, they're not really one organization, truth be told. I mean, like they are, when you look at one big bank in one big country, it's, 50 different back-end systems. But if you look at that 50 back-end systems across 50 countries, like, oh my God, like how do you solve that problem? Do you know what I mean? Like you need it's the ultimate Gordian knot problem from a monolithic technology perspective. So, I can see why they can't make it work if that actually every one of these things needs to be fundamentally operated in a completely different way. But that just isn't how you would, if you're going to start a tech business, you wouldn't build a tech stack for each one of these geographies to go into it. But I mean, Alex, I can't imagine really the US market really noticed HSBC leaving, to be honest with you. I think in certain states, I think people presumed they were a sponsor of the airport lounge more than necessarily a bank in that sense. But what do you think to this one?
Yeah, I agree. I mean, I think the U.S. expansion and then pullback is emblematic of something we see a lot with banks or other companies that come to the U.S. market and then find it's actually a lot more crowded and difficult to compete here than you might think from the outside. And I mean, to me, the bigger question, and I think HSBC is a good example of this, is as you said, these are really like independent businesses or business units that are operating in different countries. And the only thing that really ties them together is a brand. And I do sort of wonder if the value of a global banking brand is just less today than it used to be. I wonder if banking sort of has fundamentally changed, and your right to win in different markets probably has a lot less to do with this global name that you've been cultivating for centuries than it used to. That's sort of my general theory here, because I don't really see any other particularly strong advantages that these brands have in these markets.
Yeah, it's an interesting one, isn't it? What is, I mean, we're going to, like, sidebar, what is trust in a digital age is like a special we need to do, because there's like 3 hours of a conversation that we can go into on that one. But it is an interesting point, isn't it? Which is, strategically, what is the advantage of being big in this market? And actually, if you're, the economies of scale that you should be able to bring by being awesome at something and, rolling out being awesome of it in other places. When you've got the heritage of many of these organizations being through mergers and acquisitions over the last, 100 years, let's go for, then actually, I mean, it makes it really difficult to see the interlocking web of, culture and technology and everything goes there. Is that really a strategic advantage? I mean, it sounds like debt to me rather than a positive, but, maybe we'll see. I mean, do you think this is potentially, though, a kind of a, hey, let's get back to what we're great at doing and then go again, Alex?
Yeah, I think it is. I mean, I think Asia's a market where HSBC has demonstrated that they have some strength and that they have developed a right to win there. And so putting more resources where you can win, I think, to your point, makes a lot of sense. There is, I think, particularly when you get into areas of banking like wealth management, there's a bit of an ego element to, I think, this, where you're like, oh, there are rich people who live in this country. We should go, get that market. And so, it'd be cool to have an office there, to build branches in that market. And so I think we are definitely seeing, and not just with HSBC, but like in the US, Citi is going through a similar sort of transformation where they're sort of resizing and trying to figure out what the right size is. And I think a big part of that is stripping a lot away of the costs that were driven maybe more by ego or an assumption that you could win everywhere that has proven not to be the case.
Yeah, no longer those big marble offices. I do miss them in some instances. But what do you think then, Paul? I mean, is this a sort of HSBC moved away from the whole, the world's local bank. But I mean, increasingly, there's a sort of a shift towards, fintech is all community, right? This is about building products for people in communities. That inevitably is more of a local play than it is a global play. So what do you think to that?
Yeah, sure. It is interesting. I think, when I saw this story, I thought of HSBC's other big news story, especially in the UK earlier in the year, which was the purchase of Silicon Valley Bank. So really targeting that fintech niche in the UK, serving a local market, moving out of one in Mauritius, which I can't say I know much about, but moving right into where we play in the, the SVB space. I think the conversations you guys have just had, it shows they adopt different strategies for different markets. It's not one homogenous beast. It has different strategies in different places. So, I guess my take is we've seen HSBC growing in the UK or growing certainly more in towards the fintech and fundraising side and business banking side. That's our experience with them.
Yeah. I guess, look, we shouldn't judge them in terms of what their focus is and where they want to get to. I think probably the biggest conclusion for the four of us on this one is we probably want to know more about the banking situation in Mauritius, which I think requires extensive, primary research that we should probably organize as a four. But maybe we'll take that one to WhatsApp, hey? Right. So next story that we had was a super good one. And Paul, actually, it's great to have you on board to talk about this one a little bit more. We picked it up from Finextra, but Chip reports first profitable quarter, which is by no means a small feat in the world that we live in today. So Chip, and I should add, the award-winning 11FS award-winning Chip, winner of the best onboarding last night at the 11FS did I mention we did an awards? I think I've mentioned it 4 times now. We attracted £2.8 billion of net cash deposits between January and September of 2023. It also saw its number of active monthly users increase 164% to more than 215,000 accounts. It now has 790,000. There's a lot of numbers in this, Paul. I'll come to you for verification of all of these shortly. 790,000 registered users and holds customer deposits of more than £3 billion. Chip says the results were driven by the launch of a new savings account, and consumers sought to capitalise on the rising interest rates. You're straying into a very esteemed group of people here with ClearBank, Bunk, Klarna, Monzo, Tandem, PensionBee, and a bunch of others who have all discarded the growth at all costs mantra in that race for profitability. So, congratulations, Paul. That's a massive step for the organization to take over that period of time, particularly in quite a difficult period of time, actually, for many organizations out there as well. So tell us a little bit more about what that means for Chip's overall strategy. And actually, was this I won't say it's nobody bumps into profitability accidentally, but was it a changing in tact when it came to that being the goal?
No, thank you so much. I think there are a few points to touch on, but the business's overall goal was always to reach profitability. We can say that it's come sooner than planned, and we really did jump on the opportunity. And we're an agile startup. We're able to move quickly and really target certain product lines. We've seen enormous customer deposits, largely due to our ability to deliver that savings account with a really attractive interest rate. But the story goes back a bit deeper and a bit further. I think you look back at the Chip story. I've been at Chip for over 5 years, but we were originally an e-wallet helping people auto save, and we took the bet back in 2019, I think it was, to shift our infrastructure away from e-money onto embedded banking to give us the ability to offer real FSCS protected savings accounts when interest rates were near zero, because we knew in the long term of building out the wealth app, people need that cash base. So we took that bet, and that work is, it's not an overnight success. It's happened very quickly, but that work has been, being built for a couple of years. So we have that embedded banking technology. I think we also have something which is unique among wealth managers and actually other savings firms is we can set our own interest rates, but we don't have a lending book. So Chip could go to market and we can offer really competitive rates, and we can see, people are betting on Bank of England rate increasing again. We can go out before the banks, and we don't need to worry about that net interest margin or we set our margin, we take that spread, and that's how we get the profitability whilst challenging, going for the growth at the same time. So those two things happened. And look, we've ridden a wave. We really have focused on driving new customer deposits, but we've been very specific about who we've been targeting. And I think it would be amiss just to say we went out to market with a strong interest rate. We've worked with our branding and our marketing teams to really go and target a specific type of customer who fit into our overall vision for the consolidated wealth app for what we're calling the aspiring mass affluent or the mass affluent customer base in the UK.
Well, I was going to say, I had started to notice on the tube your new ads talking about assets but making them more personalized. And I remember thinking at the time, this feels like a definite shift between the Chip that I knew that came out that felt almost a little bit like Plum or Clio, where it was like, hey, here's like a little bit of savings, put it aside. It was more long-term thinking, but in a relatable way when you don't have thousands and thousands of pounds to put aside. And I actually think that to me was one of the, obviously interest rates are great and everyone's been able to benefit from them, but more actually what was offered was, we're going to talk to you at this point where you're in a cost of living crisis, you're trying to protect assets, you're trying to get into saving. Let me speak to you as a customer now. And that felt like a bigger shift than obviously the interest rates that everyone capitalized on as well.
Yeah, thanks so much. I love those tube ads as well. I can't say I had anything to do with them, but our marketing team who and our branding team have really thought long and hard about, we say the commercial objectives of the business, and we've identified the customer we want to go over for the long-term success of the business. It is somebody who is, maybe they're millennial age, they're 35, they're 40, they are on an upwards earning trajectory. They want to be spoken to in a premium and personal way. They don't want to be sold financial products all the time. They want to feel like they've got a product that they can trust, that feels personal to them. And I think the tube ads, if you haven't seen them, everyone go and have a look at it. They're probably on our Instagram, but they really encapsulate that feeling of what we want Chip to be. And we're not just and interest rate, where it's a very transactional relationship. And so, we set the target customer base. We've gone and built a brand proposition for that, and more than that, we're building the proposition out for that. So, the savings rate is great, and it gets people in the door. But we've been able to, because of that hook, acquire customers relatively cheaply, and then have a great conversation with them about, but what is your wealth journey? What do you want next? Can we sell you our stocks and shares ISA? We've seen great cross-sell into that already. We're really targeting that over the next 6, 9, 12 months to level that up. We're speaking about customers again about future products, and we'll come on to it in a minute, but we're going to build a cash ISA, because most of the customers we speak to now, and who are for the first time going to be hit by a big tax bill because they have to pay income tax on their savings, which hasn't happened for 10, 15 years. A lot of people wouldn't have done that. And, we've been able to react to those new customers as they come in, because we've laid down the foundation with that embedded banking and really thought about it for the long term. So, thanks very much. I'll feed back to the marketing guys that you love the tube campaign.
How much is that? Alex was definitely getting all giddy when they came out, and they clearly have had an impact, as you say. But Alex is Chip's CMO for everybody listening to this. I think the interesting point on that as well is like the shift in what consumers are willing to. I mean, it's great. Interest rates are a thing, and we're all excited about that, and that's awesome. But actually, like, that only works if you've got a brand that can actually have that type of dialogue with customers in that way. That point you made around that this isn't just a product play. This is a sort of an orchestration of, hey, do you trust this organization enough to tell you what their problems are in order to be able to solve them? I keep saying it's like, how do we get services back in financial services? And this is really what the core of what you're trying to do, isn't it?
Yeah, absolutely. And I think, we're not naive to the fact that savings is one part of this wider wealth proposition that we want to build. We've been able to leverage that a lot this year. And we know that if interest rates are higher for longer, they might flatten out next year, and we will be able to remain competitive, but we need to sell people other products. And 10, 15 years ago, maybe we want to be the Hargreaves Lansdown in 10 years that all people of our age are using for their wealth platform. And we need to have those conversations with people. And it might not sound sexy now, but we need to make it look sexy. And we need to make people want to come into the Chip app and open another ISA and invest sensibly for the long term. And trust is a huge thing to that. I think, David, we won last night the onboarding award or the most efficient onboarding, or the Pulse team mentioned that. And I think, the customer we're going after demands not only a relationship with it, but it needs to be super easy to use. And you need to be able to deposit seamlessly, withdraw seamlessly, transfer between accounts that in other platforms you can't transfer between. If you go to your old wealth manager, you cannot sell down from a fund back into your cash savings. It has to go into uninvested cash, back to your bank account, lock it back in. And alongside the headline interest rate, we've been building all of those user experience and brand pieces to make sure that we're fit for purpose, to up and cross sell people beyond just the interest rate.
Yeah, I mean, it's exciting, Alex, isn't it? I mean, I feel like the industry as a whole. I mean, not just with Chip here, but I mean, it's great for those guys. But actually, I mean, like, fintech's growing up, man. Like, I remember it when, it's like actually, hitting profitability and getting to that point where actually there's not only really exciting businesses, but the sustainability of that. I mean, that's definitely something I know organizations are seeing over in the US as well, right?
Yeah, absolutely. I mean, I think the feeling I had during 2020 and 2021 was like, am I losing my mind? Like, am I going crazy, or is like the rest of the world? I couldn't tell. And I think it was just because of what you said. I mean, all of these businesses need to make sense from a bottom line perspective at some point. And obviously, when you're building a venture-backed business or a startup, there's a window of time where that's not your goal, and that's obviously fine. But I think, something Paul mentioned that really resonated with me was, laying the groundwork to have a savings account when interest rates were zero, right? And I think that's a really good lens to look at how you build profitable businesses, right? Because a really great business is never going to have one product. A really great business is never going to have one business model. In financial services, that doesn't work, right? Because interest rates are up. And so this business model works great for us now, but then interest rates go down, and oh no. And we see this in mortgage every time that interest rates spike or go back down, like suddenly it's booming or now it's dying. And so you need to build a durable, multi-product, multi-business model business. And I think, Paul, what you shared is a really good example of, we want to build this product out because we know our customers are going to need this. And we don't know necessarily when this component of our business is going to be a big driver for our profitability. Maybe it might be another 5-10 years. We don't know, but we know our customers need this product. And so we're going to add that. And I think what you're seeing in fintech in the US, in Europe, kind of across the board is people being a lot more thoughtful about, we're not just going to build our roadmap based on what's sexy. We're not going to chase like whatever the newest trend is, like, oh, they're adding crypto, so we have to add crypto. It's being a lot more thoughtful about what is it our customers need, what value do we provide to them, and what's going to sort of diversify our base of how we make money over time so that we can thrive sort of regardless of what the broader environment is doing. And I'm excited to see that type of thinking in fintech.
It's interesting that, that point, Alex, look, when crypto's up and like London cabbies are talking about it, we definitely, that 11FS inbox of like, hey, we think we should do something great. Like that does happen. Do you know what I mean? But how much are these two stories actually pretty well connected? Look, HSBC moving back from being able to operate those things at a scale or a cost efficiency that actually makes it work. And fintechs, ultimately it's kind of the theory of evolution, isn't it? You guys at Chippool, you've adapted to the market quicker than anybody else can do. And therefore your ability to respond to it and solve problems for consumers is greater than other people's in that space as well. So I really feel like we're at a point in the industry where like fintechs and banks kind of like look similar from like the skin deep perspective, but fundamentally like the operating capability, the technology that underpins them, it is just not the same. These things are not the same, and they're not, it's not even apples and oranges. It's like one of these is just not even a fruit, Like, so I kind of feel like actually this point from here onwards, I feel like the gap in experience, the service gap between, what players like yourself, Paul, and the traditional organizations, because of their ability to, can you take it from an idea to the customer? You guys can do that really quickly, and that's why you guys can win, right?
Yeah, absolutely. And, it has to happen across, as Alex was saying, across different verticals and different business models, laying the groundwork for our investments proposition when cycles change and everyone's investing again and trying to get back into the market. We know that we bought that time while cash is king to be able to build out those products. And I think we're really well positioned because we have both of those products live and ready. There are a lot of firms we've seen trying to get into cash in the last 9 months who may have missed this, this growth spurt. We didn't have crypto live 2 years ago, and if we did, I'm sure we would have ridden that. We would have ridden that trend. So I think you're right, and I think we've learned the importance of building quickly and responding to markets whilst following relentlessly that mission and vision of creating the Wealth app, and we will continue to do that. We've learned lessons. We're 5 years old now, or 6 years old, I think, and I can't even remember anymore. But we're a more mature startup business, and so we know what works and how to build things quickly. And the product and engineering teams have built really efficient processes, and we bet on a strategy and we go for it. And I think that might take longer at incumbents, and obviously, we're benefiting from that.
Yeah, it's the absolute tortoise and the hare race. But maybe in this story, the tortoise doesn't win. So, all right, on that note, we're going to take a little bit of a break. We'll be back with you very shortly.
We all know SMEs are the backbone of any economy. So why are they still so underserved? 67% of them globally say fighting for survival is their top challenge. It's time for financial services to put its cape on. At 11FS Ventures, we're building, researching, strategizing, designing, and engineering game-changing propositions with banks and fintechs to better serve the SME market. We've already helped RBS better serve small business owners and sole traders by bringing metal to life. So, the question is, what do you want us to help make a reality for you? Let us know at 11fs.com/ventures. That's 11fs.com/ventures.
Welcome back to the show. Before we get back into the second half of the news show, a quick note to check out the most recent Fintech Insider Insights show. Kate Moody and our very own Executive Creative Director, Will Jones, was discussing how to rebrand a fintech. They're joined by some super duper awesome guests from Wise and Adyen and Onfric to discuss exactly what it takes to do a rebrand. What does that mean? And really, what is the different experiences of actually kind of making those things happen? Rebranding doesn't change your service. What you do changes your service, but actually how you manifest the pitfalls and those challenges is a really interesting conversation. So go and check that out. It will be probably the one below. I mean, down to your podcast client, isn't it? But let's get back into the news. All right. So the next story that we had was one that we picked up on the FinTech Times. This is the EU and Parliament reach agreement on the new instant payment rules. A new instant payment proposal will improve the availability of instant payments options in euros to consumers and businesses in the EU and the European Economic Area, the EEA. So the agreement will mean any payment service providers, PSPs, who provide standard credit transfers in euros will now be required to offer instant payment services in euros also. That's the third time I read it for anybody listening to this, just because it didn't make a great deal of sense to me. So feel free to play that back. The new rules are designed to provide greater autonomy to the European economy and less reliance on third-party financial institutions to make that thing happen. However, the agreement also considers non-euro entities with a longer transition period built in to those outside the eurozone. So, I mean, how impactful will this be? I mean, Rachel, man, this is a complicated one. I'm going to come to you first on this because I reckon out of everybody here, you've researched this one, haven't you?
Maybe.
There we go.
No, I'm really interested in payments regulation, and I find this one particularly interesting. I think it is a step in the right direction for the Eurozone for a lot of reasons, but primarily because the whole point of the Eurozone is that it's this area of free travel and therefore free commerce between all the different countries that form a part of it. At the moment, I was reading a stat earlier by the European Commission, did my research, around 11% of all transfers in the EU are in real time. 11%. This is a huge area, and I think it's easy to think of Europe as this high performing economy when you think of places like Germany and innovations coming out of France, but there are so many different facets to the Eurozone, and I think by bringing this regulation in, it enables all of the different regions thinking about areas in Italy and Spain to really compete and offer more digital services. The question I think is more around how you enforce and support regulation like this, because we're not targeting banks, we're targeting PSPs, and they might not have the infrastructure or the funds to be able to deliver these kinds of changes. And then also, I guess, what comes afterwards. Open banking came in, I remember the good old days, and we all pushed to get these APIs live, and we're still not seeing any coherent services. And so the ability to push these instant payments live is great, but then also what the PSPs do with it afterwards would be the really interesting thing for me. But I think it's a really important step for the Eurozone to bring in this kind of monetary union as well as the geographical union they have in place.
Yeah, I guess there's I don't want to sort of get into sounding like some sort of tub thumping Brexiteer. We've done those podcasts. You can go back and listen to them at another time. But it's an interesting one. I mean, as technologists, standardization sounds like a great thing, doesn't it? The practicality of that is, okay, whose standards are we going to use, right? Because everybody thinks their standards are the right, Alex, I mean, the implementation of even the, Fed's payments capability. I mean, it's like agreeing what standard and, what open banking looks like it's not an easy thing to do. And almost like anywhere where you find you have countries or large organizations compromising to create a standard, the compromise is usually in the end result, right? Not just in terms of what the standard actually looks like. So, I mean, is this type of thing, this particular example aside, because I think, again, I think we need another hour and probably 4 days of research to really dig into the details of this one. But I mean, standardization sounds like a good idea, but the practicalities never really live up to the expectations, do they?
Yeah, I think that's a good point. I mean, we're dealing with this, as you noted, in the US right now, both on faster payments and open banking. I swear we're trying to catch up to all of you in Europe. Like we're on our way. We can sort of see you racing up ahead of us and we're trying to catch up. But I mean, we also are trying, I think, to take lessons from what you've seen. And I think Rachel points out a really good example that, with open banking, you put these things in place and then you're like, okay, now everybody go, and it reminds me of the idiom, you can lead a horse to water, but you can't make it drink. Like the part of that they're not saying is you can lead the horse to water, you can't make it drink, and it'll probably kick you in the face because it's mad at you at the same time. And I think that's kind of what you see with a lot of these requirements where it makes sense. It's nice to have a standard, but there's something almost like enraging to private market participants about being forced to a standard that they didn't want or didn't agree to. And they'll a lot of times really kind of slow down introducing products that take advantage of these capabilities and actually like pushing them the last mile to the customer. And obviously that's what regulators and governments want, is for these capabilities to actually make it into the market. But that requires private market participants to play an active and enthusiastic role. And I think that's what you see missing a lot of times with these things.
Yeah, it's an interesting one, isn't it? And that dynamic, I mean, it's been fascinating really over the last decade, really, to sort of see that dynamic play out with different measures of those things in different markets as well, right? It's really been the fuel, as Rachel says, to bring that change about, or at least bring about competition in the market that actually allows the pressures on the incumbent organizations to do interesting things in that space. But I mean, what do you think on this one, Paul? I'm not going to draw you into the intricacies of the 700-page document that I'm sure was accompanying all of these things. But I mean, standards seem sensible, don't they? But
yeah, I think, and I'm not in the detail of it, but I think when you talk about standards, and especially in the EEA and the EU, as a UK firm potentially looking to expand or progress internationally, where we assess different markets, and the sound of it is good, right? For me, if it's we can expand into Europe and the standards will be the same, and actually in whichever market in the EU you move into, the customer, we can hook into instant payment rails, and our Spanish customers don't have to wait 5 days and have a worse user experience than our German ones. For me, it sounds great. And it's like you say, is the implementation as effective, or does it look like what it's meant to look like to the end consumer? But no, from my perspective, if it makes the barrier to entry lower for international incumbents and creates competition, then I guess that is a good thing.
Yeah. I think I come back to my point earlier on. So long as the standard gets you to a point where it's a good standard, not just a standard. Do you know what I mean? In terms of, I think actually where the push with something like open banking in the UK, it got us to a good place. Like actually the quality of the data, the service that was being provided by those services was good. Therefore, actually, it creates a good foundation to build things on. Have we come as far as we would have liked in terms of all of the hype around open banking and those standards around it? Maybe not, but there's definitely a lot more people doing things with it now than there was even 6 months, a year ago, which is exciting to see. I think you were about to jump in, Rach.
I was just going to say, I'd argue when open banking first came out that it wasn't that steady a standard, and it pushed the realms of competition from just aggregation, because at first when it came out, it was the race to get aggregation live and to get aggregated payments live. And then it was like, oh shoot, what is the actual service? What is the customer proposition that goes along with it? And I think that's the similar position for instant payments. We're acting like instant payment is the thing that you can compete on. No, think about consumer duty. This is what customers deserve and expect as digital consumers. And so what is the innovation in the payment space that comes off the back of instant payments? Because, Alex, to your point, we shouldn't be pushing private companies out of this race, but also, if they're competing on instant payments, it's only because the Eurozone has been behind to date. And so I think this infrastructure will bring more competition, but around more interesting things, as opposed to the foundational experience, which will benefit more of the smaller participants in the market.
What do you think, Alex?
Yeah, I agree. I couldn't agree more. I mean, I think that it's very much of a push and pull sort of thing, where it's like you have to sort of jump ahead and then pull the market up to where you need them to be. And I completely agree. The value really gets unlocked when the standard is set and everyone knows sort of what the rules are, and now you can all compete within that rule set. But if you don't have that, the status quo tends to sort of persist. And I think the other thing we don't take enough into consideration with this stuff is the status quo is really profitable for incumbents, right? And so there really is no sort of natural market reason for them to change. We're still, I was talking to someone the other day about the persistent use of checks as a payment method in the US, right? And like 40% of payments are still made via checks, which is insane. But there are companies that benefit from checks being written and processed, right? Someone's making money from that. And so you always have to, I think, sort of look at that. And that's where I think regulation can make a big difference.
Yeah, I mean, the whole concept of a notary over in the US, like there's like thousands of people who are like, you know, it is. But do you know, I feel a little bit with this one, even where, do you know, I felt maybe, 5-6 years ago, I kind of felt like there was this grand plan, like, and I'm not, don't worry, I'm not getting into like a religious belief thing, or I felt like the regulators were moving us in a direction, and it was almost like, I've got 2 small kids. We used to blend vegetables and put them into things like hide vegetables because it was good for them. Right. They didn't know it was good for them, but it was good for them, right? And the sort of advent of these standards, the advent of mobile, like mobile banking taught the banks that they didn't know what good customer experience was, so they had to kind of rethink it. You know, open banking and PSD2 taught bankers what APIs was, and that's good as well. You know, it kind of moves these things forward. So I think the sort of knock-on effect of these things, even if they don't, there's always the strategy and then the knock-on effects of those strategies. I mean, it feels like actually it's moved the narrative forward. It's moved the language, the conversations, and what big incumbents think is important. Have they got all the answers and have they solved all those problems? Hell no. But again, that's probably a story for a much longer conversation. So, all right, moving on. There was a lots of other stories as well. This one we picked up on AltFi. Klarna launches global rollout of creator and retail growth tools. I mean, this is an amazing space, and we've had a few different people talking about this on the podcast before, but Klarna, the buy now, pay later brand, is branching out with the launch of Creator Stories and Ad Manager. The former will support creators with tools to create their digital storefront on the Klarna website. The latter will create a personalized shopping experience for customers who choose to share their info with Klarna. Both services are part of a wider strategic move to become a growth partner and retail media network within the industry, according to their CMO, David Sandstrom. I mean, Alex, this one's super interesting. This sort of creator developer economy. I mean, there's lots of interesting things happening in that space. I mean, it's amazing to see a gigantic organization like Klarna really sort of pushing into this as well. But I mean, is this almost like finding where they can attract niches to provide really focused services?
Yeah, I think it is. I mean, I think there's a real link to the way they market and the sort of brand that they want to have. And so I think creators are a very natural fit as a segment that they want to enable. But, it's part of a broader shift at Klarna away from their roots to really being kind of I've always sort of thought of them in recent terms as like the front 40% of like Amazon.com. So it doesn't have all the logistics on the back end, but like the marketplace, the discoverability, the value adds to merchants, the advertising network, like they want to be that. And I think, this ability to create digital storefronts kind of bridges them into being in the same realm that like a Shopify is in, but like the game is merchant enablement, and the financial services products that get hung around that are in a lot of cases sort of secondary. And so this seems very consistent with their vision to help merchants sell more regardless of what the specific capability is.
I mean, it's an interesting strategy, as you say, as well, when, you come into a market like Klarna did and, not just like awesome Snoop Dogg adverts, which were great. I think Katy Perry's currently doing one as well, potentially. But the, the idea that you either go up or down, right? You'll push yourself into services that add value, or potentially your product becomes a commodity and you become commoditized. So, is this their push for added value services, do you think, to kind of keep that crown?
Yeah, I think it is. And I think that, the thing that Klarna has demonstrated to me is that they know exactly who their customer is, right? And I think that's one thing in the buy now, pay later space that sometimes gets a little confused is, well, are we serving the customer? Are we serving the merchant? Do we want to be our own financial services brand, sort of independent of all of these things? And like Klarna, to its credit, is laser focused on the merchant is our customer, the retailer is our customer, and everything we can do to enable that chief marketing officer who works at this retail brand to be as successful in their job as possible. That's what we're going to do. And so, yeah, I think that this is them doubling down on that. And, you can say that, okay, well, that means that maybe Klarna's retail consumer customers are not actually the customer. Maybe they're more the product, and you can get into discussions about affordability and the concerns with buy now, pay later. But from a business perspective, I see zero confusion at Klarna about who they're trying to serve and where they're investing, which is, I think, a very smart way to build your business.
Yeah. I mean, it's an interesting one as well, Rachel, in terms of like their push into, really like hyper personalization in that sense as well, which, it's an interesting territory. I mean, it's sort of the promise of the internet really was it's the shop for you or the personalized experience in that sense. It can get a little bit freaky in Amazon sometimes, I'll be honest with you, like buy a joke gift for somebody and you can't get it off your home screen for forever type thing. But what do you think? Is this a good use of kind of algorithms and propensity modeling to really give a personalized service?
I feel like there's some kind of gag because I have very strong opinions on buy now, pay later, and it's always brought up when I have to speak about fintechs. So I think Klarna is great for a lot of reasons because they've made
Strap yourself in for a 20-minute round here, everybody.
No, I'm gonna keep it brief, I promise. But no, obviously Klarna's great. It's enabled people to find the items that they actually love, which I think has been lost. Amazon used to be a place where you could find high quality goods really easily, and now it's become this huge marketplace saturated with products that may or may not fit the bill. You'll order it and you think you get a chair for your garden. It's actually like a doll's chair or something, and I don't know. Like it's crazy and it's hard to navigate. Klarna is completely different to that, and I really love how they have, I don't use it very often, but when I do click into the app, it's based on the purchases that I've made, and by enabling merchants, they have enabled a better consumer experience. I think with that though comes the responsibility of someone like Klarna to ensure that by pushing the products that they know that I need and I want, you're not just pushing me to buy it straight away, you're helping me find more intelligent moments to buy it. Like finding me and curating the right objects is one part of it, but if you happen to have expensive taste, maybe I don't need to buy all those things that come out all the time. Perhaps you can find me a better time to buy it. Black Friday's coming up. Could you find me some sales or find me more responsible ways to purchase? And I think that for me is what's missing. Their algorithm is perfect because of the merchant relationships that they've forged, but what's missing is this level of consumer responsibility in their propositions, which I'd love to see from them so I could love them a little bit more, but I'm just not there. Was that brief? Was that okay?
No, it was. I feel like I touched a nerve that I'm worried I'm about to touch again. But it's an interesting one because we've had that. Obviously, the UK Consumer Duty Act and blah blah blah. But actually, we've had people on the podcast who have a very different view. We had Ron Shevlin on, and he was like, tell me what I can spend my money on and I will never come to that organization ever again. My money is my money. What I do with it. If I want to go into debt, I want to go into debt. It might just because Ron's quite a grumpy old man, I'll be honest with you at times.
That does sound like Ron. Yeah, that
the point is there.
Ron.
Yeah.
It does. Yeah, it was a pretty decent impression. I didn't do the accent, but the feeling was there, wasn't it? But do you know what I mean? So it is a fine line in that, isn't it? Which is but I think the challenge there though isn't necessarily the problem with consumer duty in the UK is essentially are the banks trusted to say to somebody when they've had enough? Do you know what I mean? It's like the bartender at the end of the night type thing. I'm like, no sir, you've had enough. Like actually, is there a good enough relationship between the brands and the customers that actually they have that type of engagement with them? Or are banks, I think it's quite rich for banks to try and play that position. It's like betting companies trying to, market around being, sustainable betting. It's like you can't be both of these things. You've got to be one of them or the other, or you've got to fundamentally change your business model. So Klarna is there to sell stuff, isn't it? Really, and I'm not saying it's a good thing or a bad thing, and I don't want to anger you, Rachel, but it's like actually it's an interesting problem, isn't it? Ultimately, is the business model of financial services to enable people to do stuff, or is it there to help people be better off? I would argue it's currently the first one, but there's a whole opportunity for it to be the second one. But I feel again, God, we just keep taking the scab off real big things, don't we?
Yeah, sorry, I was just going to jump in. I mean, there's a big elephant in the room here in financial services. We're the only one where hyper-personalization and helping people to do more works, and that's in savings and wealth building. So, I mean, the traditional model of financial advice is to meet with a financial advisor and they know you inside out on your hyper-personalized level, and they tell you should put away more of this. So it's the complete opposite of what Klarna are trying to get out of knowing information about you. They're trying to know information about you, your patterns, so they can sell you and probably make you worse off financially. Something we're really trying to do and really trying to close that advice gap and help people save more money is we want to know as much as we can about our customers so that we can spot those areas at which they should be putting that money away and probably not buying those shoes or whatever it is they're logging onto Klarna. And I'm as bad as anyone. I love spending money, probably too much for someone who works at Chip, but it's heartening knowing that we've got real people trying to solve that problem in the market and trying to counter some of these behemoths who it's so easy to spend money. I can use Apple Pay, I can do Deliveroo, I can buy Uber, and we're trying to make it that easy to save money as well. So these developments
it comes back to...
Yeah, go on.
I think it comes back to that point I was making earlier on, though, Paul, which is like, if I'm sneaking courgettes into a bolognese to make my kids better off, actually, I mean, it's an interesting one, isn't it? Because tricking people into something or engaging people, bringing people into the context of why it's good for them and the benefit of it. I don't want to cast aspersions. You're not tricking people into anything, by the way. It's, bringing people into the fold of doing that.
Yeah.
It all comes down to whether it's good for them or bad for them, doesn't it? And actually, the context of that is actually, like I say, I can see Laura already, like, this is going to be an hour we need to get everybody back to kind of talk about. But I really think that would be a fascinating thing to dig into. So me and Jason a couple of weeks ago actually met with the CEO of one of the challenger banks in the UK, and we had we started that conversation. It was inherently is banking business models at odds with actually a culture of solving the world and changing, because actually fundamentally at the end of the day it's financial services, right? We all know the industry we're getting into. It is about lending people money. It is about savings in those senses. So, but actually is the context the bit that's missing out on? Because all of the things that you're referring to, Paul, are really what and it's weird. I sound like such an old man, but it's the stuff that people used to do really well for people. Do you know what I mean? It's the stuff that branches were really good at doing, and actually having lost all of those really deeply empathetic people who might have been able to go, Rachel, I think you've had enough. That might have been the role that they played. But let's definitely get this back together. Is financial services inherently evil podcast? We'll do that one next, eh? All right, moving on. Big Click Energy. As always, every week there's a bunch of stuff that we don't get the time to cover in a major way, but we're going to give a little bit of an overview of one of the stories that popped up that we thought was interesting. So, quick fire round. I think, Rachel, you're going to take this one, right?
I would love to. Thank you, David. So for this week's Big Click Energy, we're talking about Revolut, who have raised their monthly fees for premium customers. Revolut currently offer 5 plans from their free offering up to Ultra. However, they've announced users on their 3 or other paid plans will see a small price increase of up to £2 per month. In return, these users will get additional access to lifestyle app subscriptions previously reserved for the top tier customers. So we're increasing the benefits accessible to all of the other plans. And these subscriptions include a wide variety of services from the Financial Times to Tinder, which could save customers up to thousands of pounds per year. Revolut are also promising additional features and benefits to their Ultra members in due course. I find this a really interesting move from Revolut, and it ties in with their relaunch of Revolut 10, which has seen a massive overhaul of the app, the UX that they offer, and the ability to navigate through the super app. Personally, I think that this slight raise in fees is a really good thing from them, but only because of the benefits that they have on offer, while also maintaining a really solid free offering. And I think the only reason they've been able to do this well is because they have such a solid core offering, and the pricing is still pretty low for the other benefits that they have on offer. Things like subscriptions are actually tangible benefits, as opposed to some of the other benefits you can get from a few of your banking providers, which you won't actually ever get to see the benefits of, like lounge access and all of the weird lounges that you never actually want to go to, and you just want the bougie ones, which explains my issues with not needing to use Klarna more than I should. So I think that's all there is on Revolut. I don't know, Dave, if you've got anything else to add on that one.
No, it'd be interesting to see. I mean, whether actually the customer numbers of each of those tiers changes as a result of this or not. And, there's always an interesting thing around those services, whether people there, is it perceived value or is it real value in terms of things that people actually use, right? So, but let's see. I mean, I'm sure if it goes well, there'll be some customer announcements soon. If it doesn't, then there'll be a different announcement, I guess, at that stage. All right, the last story that we're going to cover, and I read this one earlier on and I was like, we do a fintech podcast. What's this got to do with fintech? But it's something a little bit random. But actually, I think it leads to quite an interesting conversation. So, yeah, I see what you did there, Laura. The Booth supermarkets are to ditch self-checkout in the north of England. Doesn't translate great for a big international audience, this, but Booth is quite a high-end supermarket in the north of England. The only 2 stores will continue to use their self-service tills, with the chain favouring traditional manned trolley-friendly tills with people there to kind of manage those things for you. And they are the first UK supermarket to rescind the use of those self-service machines. They came out and said, we're not a great fan of self-service checkouts. The Booth's managing director, Nigel Murray, told The Grocer, apparently that's a publication all about greengrocering, I guess, we pride ourselves on great customer service, and you can't do that with a robot. I think this plays a little bit to what we were talking about earlier on, which is they're coming out and saying good customer experience, but what I read into that is sales have gone down of different things, right? Because you wouldn't make this change if it wasn't going to fundamentally affecting the revenue of you. But this mirrors massively what's happened in financial services over the last decade, right? We've kind of got rid of all of the people and gone to mobile apps being the thing that's the interaction point for. So, I mean, Rachel, it's quite an interesting one, isn't it? If supermarkets are going to start moving back to the good old days, I mean, are we going to see a push from financial services where actually upsell, cross-sell cannot really be done effectively in the same way as it was before? Do you think we're going to see a bit of more of a push towards more personalized banking in that sense as well?
You know what? I think we will, but I think that it's always been there. I think it's to do with the scale of wealth. So Booths, they're not just a Tesco or a Sainsbury's, they're a high-end supermarket. And for example, if I go into a Whole Foods, you can bet they haven't got any self-service anywhere. They've just got people manning the tills because you're going in for the higher service, the higher quality goods. And so I think in that same vein, when you think about more bespoke or more high-end services, there is always a higher fee attached to it, which means that you expect higher servicing. Even talk about the Revolut story that came just before. One of the things that you get guaranteed on the higher tiers is 24/7 instant support, more prioritized support. And so I think that it's something that we have seen a lot in the digital space, this emergence of tiered services and paying to get higher service. I'm not really surprised at the supermarket, because I can just imagine someone going in with a very expensive shop and then trying to scan it all through and it just not working out. So I don't know. I wonder, maybe it was a bet for them to try move to a more digital model and them just seeing it not play out.
Yeah, I mean, it's an interesting one, isn't it? That whether it's digital or whether there's sort of that overlap between the physical digital space, then wealth propositions actually don't fare particularly well, do they? So you are good. It's a good point, actually. If you're trying to scan your £15 pineapple and you're getting frustrated, I mean, it sort of tarnishes the experience for you in that way, doesn't it? But I guess we've seen this in wealth propositions with banking as well, though, right? The only real differentiating point is, a fancy card or some calligraphy on it, right? So, I mean, what do you think, Alex? Do you think premium experiences can be manifested in a digital space?
All right, well, so I'm doing research as you guys are talking because I don't know what Booths is. So it looks like kind of like Trader Joe's, to put it in like a U.S. context, maybe like high-end, relatively
Whole Foods
small.
vibes.
Whole Foods. Okay,
Mhm.
all right. So
Yeah.
So I think I'm dialed into the right experience now. Yeah, I think it's really tricky, to use a completely different analogy, but I'm in Montana in the U.S. And in Montana, we pump our own gas. So when you go fill up your car with petrol, you are getting out. You're doing it. It's all self-service. You swipe, and quite frankly, like that's just what I grew up with, and it was a very normal experience. When I lived in Massachusetts, Ron Shevlin's neighborhood, for a little while, I was shocked to discover that they had attendants who would pump the gas for you. And I found that experience to be really weird and off-putting. I think it was supposed to feel like premium and, oh my gosh, you don't have to do anything. But it was like really strange to me. So I do kind of wonder if a big part of how we define like what is a luxury experience is less to do with the actual mechanics of the experience and more just what we're accustomed to. And to put it in like a financial services context, if you're talking about like wealth management, and Paul, I'm sure you have a perspective on this, but if you're 25 and you've never gone into a branch and talked to a private banker and had them sort of massage your ego as they tell you about your net worth, your definition of like luxury and what a premium experience is like has no grounding in like a physical context. So if you are interacting with an app and you feel like you're getting the exact answers you need and it feels like a premium experience, I think you can cultivate that type of premium experience without necessarily having to have the human touch or the in-person experience. But I don't do that in a day-to-day basis. Paul, what do you think about that?
Yeah, I absolutely agree. And I think we touched on it briefly earlier, Rachel. It's something that Chip is trying to deliver on. You rebrand and you deliver your product and your entire branding and messaging and tone of voice around being premium and personal, which is what we're going for in our space. However, I think in the wealth sector more generally, people do value that real life human interaction, to be told, yes, that is the right decision. You're not doing something wrong. Maybe someone just to give you that human touch before you make a big life-changing savings or investments decision. So we're trying to find the balance to close and reduce that cost so you can get real human interaction whilst also delivering it digitally.
Just for reference, I'm a Morrison's guy, so like that's where I'm shopping. Alex, you'll have
I've
to
never heard of
to Google that one.
I have to do more research.
Yeah. It's way too fancy for me, Booth. Like, I feel like I'd just be out of place, like, quite frankly. But on that note, we are going to have to wrap up this week's show, I'm afraid. You come back for more grocery advice next week, by all means. But if you have liked this podcast and have liked the guests, it's always good to know whether you can find out more information. So, Alex, where can they learn a little bit more about you and all the good things that you do?
Absolutely, yeah. I spend a ridiculous amount of time on Twitter at AlexH_Johnson. And if you Google Fintech Takes, you'll find the newsletter and the podcast.
Very good. I love the idea that we've made you just a little bit closer to understanding shopping habits in UK as well. Like, I feel like that was some good research that was done there. So
it was a great use of extra time.
Paul, where can people learn a little bit more about you and all the good stuff you're doing at Chip?
Yeah, just connect on LinkedIn, Paul Delaney.
Very good. Rachel, where can people find you?
Yeah, probably LinkedIn as well. I'm Rachel Pandyan because Twitter got too much for me after the rebrand.
Yeah, I think there's a lot of people in that. I mean, I think there's a general consensus that Twitter's sort of dead now, right? Musk can come and tell us he's going to turn it into a financial services player as much as he likes, but the rest of it is gone, unfortunately. But hey ho. As for me, do you know what? Send me an email. Like, I really fancy some emails next week. So david@11fs.com. Thank you so much for listening, everybody. Please do jump into any social media channel you like. Search for 11FS, search for Fintech Insider, or if you want to, email us at podcast@11fs.com. Thank you very much for listening. Goodbye.